Now, while Uber's IPO may be the biggest since Facebook, plenty of tech unicorns have stampeded to the market recently. And it does create a very different result. The varied responses, how an IPO is priced. Now, look at Uber's chief competitor, Lyft, right? Remember Lyft. So Lyft priced too high. The IPO was at 72, down 2 days later, it's at 27% lower. So it opens, it goes whoosh, and then it falls way back. And you've got the other side, Beyond Meat. Now, the IPO price there is at 25. It trades at 46, closes at 65. It's up 163%. That is clearly too low. There's an arguable difference between the two, but they both have competitors. They both came to the market in difficult times. They both had a raison d'etre that could be called into question. Pricing an IPO correctly is challenging. Finding the sweet spot between what buyers and sellers want is the key. My next guest calls it the Goldilocks zone. He's Rhett Wallace, who's the CEO of Triton. Good to see you, Rhett. How are you? Nice to see you. Make yourself comfortable.
Thank you.
Let's take the two examples that we've just been talking about.
Sure. We're talking about Lyft and Beyond Meat.
Lyft and Beyond Meat.
Okay. Two totally not comparable companies in any way.
They're not comparable. But, no, they're not comparable in any way, except they should follow the same principles of IPOing.
Well, look, people like to complain about investment bankers, but this is where we see that investment bankers have a very difficult job, because if you're too low, then you've done it wrong, and if you're too high, you've done it wrong. So the Goldilocks zone is actually very difficult to achieve, especially when you're doing it for a company like Lyft, or especially Uber, which is so big, so broadly held, so controversial, loses so much money, but has so much promise. And $10 billion is going to change hands. Right. So getting that right is very, very hard when you have so many different constituencies to please and they have different interests.
When I started in all of this, we used to say on an IPO or an offering, if you got a nice 10 to 15% bump, everybody felt happy.
Yes.
You'd agree with me on that.
If you can hold it there, right? Lyft had a nice bump, but they couldn't hold it.
No, they had a huge.
Right? So the bump has to be sustainable.
You don't want it to break its IPO price. That's devastating.
Correct. But even to give up the bump, I think, is painful, right? To come back to the IPO price in short order.
Every week every day I do the program, The Express from the Exchange, and I talk to CEOs who've just IPOs. Now, those who sort of go down, or those who rise quite sharply, I always say, but you left money behind.
They left a little money, but it's also important to know that these companies are only selling 10% of themselves, right? And they'll do follow-on offerings. The employee stock will all be priced based on these things. So setting the tone correctly is much more important than a few dollars of proceeds. This is, again, where the Uber situation is interesting, because for every dollar of price, we hear it's 45 to 46, just like everyone is hearing. Well, that's $150 million of difference in terms of cash in the till.
Whose shares will lose out? Because in the Uber case, is it fresh stock coming in, or is it existing holders to divesting?
So the primary deal is the principal deal that we all hear about. The green shoe, the over-allotment option, is all secondary, and we'll see if that gets done. Right? Lyft, I don't think, was able to deploy its green shoe.
The green shoe, explain.
So to stabilize the stock, the underwriters have the option to over-allot, or to buy an extra 15% of the deal from the company and sell it. And so that's when a deal is successful, you're able to exercise your over-allotment option, right, and sell additional stock into the market at the IPO price.
Right, and that comes from the existing.
In this case, it's secondary sellers.
Yeah. So let's just look at this. Tomorrow, you'll see we have some experience on this program, by the way, with Snap.
Oh, my favorite.
Exactly.
I love Snap.
We bought Snap.
How to get it all wrong in every direction.
We bought Snap at 27. And we've never seen anything like it since.
Terrible, but totally predictable, unfortunately.
Right. So tomorrow, when we see the stock open, let's say prices tonight at 45 to 46. It opens tomorrow, I don't know, 55, 60, maybe 40. No, okay.
If it goes into the 60s, that's scary.
If it opens at 40, say it opens at 50.
Yep.
And it trades around 50 to 55 over the course of the day. That's reasonable.
That's a home run. Morgan Stanley gets high fives all around, and everyone's happy, and then it has to stay there through all this China stuff, right, for the next couple of weeks. And then it's a win.
At what point does the Quest Means Business buyer decide, I think I should have a punt on this?
So that's a really interesting question, because the thing about Uber that makes it a very difficult decision for very serious investors right now is that as big as Uber is, I mean, Uber sells $50 billion of volume a year. It's a gigantic company, but it's still early. Right? We still don't really know what the long-term business model looks like. If the autonomous driving effort is successful, then all these problems with striking drivers and things like that, as well as the cost of paying drivers, will go away. Who's going to own the cars? Right? It's not clear. So there's a lot that we still have to learn about this business before it's something that you would say is a totally safe thing to put in your kid's college fund.